Hey, greetings. Happy Tuesday. Hello, hello.
Hey,
Hey, Jonathan. Why isn't it showing? Swear to God, I have my mug up here.
you have your mug up?
I sort of kind of do. I just don't have it turned on. This'll work. There we go. Hey, happy Tuesday.
You as well?
All right, when does this freight train slow down? Stop, crash? That's the topic today. Welcome Tuesday. At the close, guest captain interview with Jonathan Gibbons of VigTech.io and Samantha LaDuc here, LaDucTrading.com. I am asking Jonathan to help make sense of this market melt up, which has been a nice grind. And I got way too many long positions on, as my risk manager reminded me this morning, as I entered three more. So actually with Andrew's help, I entered three more. So I would love to first and foremost talk about where we are at with FOMC heading into tomorrow afternoon, and not any changes expected, maybe some guidance on the long end, but nothing really earth shattering. They meet today, of course. Again, it's like the trade deal keeps coming always. But most importantly, we have volatility just subdued into, I don't know what, just total complacency. So invited Jonathan to give his overview. He writes a great daily called The Juice on VigTech. Let me see if I can actually make sure that I'm okay, I'm going to stop this share. There we go. I'm going to ask him for his views because I read his daily, but I want him to talk live and dig in a little bit into this put call ratio extravaganza that we have, indicating extreme optimism and complacency. Go.
Okay, go. All right. First and foremost, like I think the funniest thing is I just on the juice I've been tracking this little piece called Mr. Greedy. It's just a GIF where the little greedy guy rolls up and eats the G for gamma, right? And that's our fancy market indicator that's free. You can come and get it at the juice.
When you show your screen, show
Yeah.
where it is, okay?
Yeah. All
I don't
right.
want
All
to
right.
leave anything up to assumptions. I want you to show where it is because, yeah, it's
Okay.
good stuff.
Hold on. Let me pull it up. All right. So, all right, you guys can see the screen. So, all right, here's our app address. The URL address is vigtech.io. But if you go to the juice, it's our kind of daily missive that we put out. That's kind of gift based commentary with some jokes usually, and some poking fun at the market. And then we've got I've been doing a daily kind of rundown on video that's on YouTube, and then also a chart rundown to kind of give some perspectives on that. But just chart by chart of the major indexes. But this is what I was referring to with Mr. Greedy. Is I'll just leave Mr. Greedy here for a while until they stop eating the gamma G, right? And as far as it goes to tomorrow, right? I was looking for some quantitative tightening last night. Not really, right?
Yeah, really.
Joking with the Anchorman gift right there, but that's the juice. It's every day, for the most part. Like today, we usually just reshare the webcast that we do with Samantha here, but you can get this and take a look at all these via our website. So the as it relates to the market, right, and as it relates to you were asking the question about when does this end or not, right?
Do you see any signs of slowing? Because it's been a freight train and not complaining, but the point is too much, exuberance gives you a heck of a hangover. So just wondering if you see any signs. I always ask.
Yeah, no, like the Mr. Greedy is coming from the single stock. Just looking at our options flows, just single stock option flows greater than 20,000, and premium with a couple other little factors in there. But it's got to be less than or more than 0.60 to get rid of that kind of joking gift thing. But it's like not really a joke because these are really driving a lot of what's transpiring to an extent, right? I actually will dig into that a little bit further.
Yeah, explain this just one more time. It under 0.60 for how many days consecutively in a row?
It's been under 0.60 for 20, as of today, 20 of the last 21, but you got to discount the one day of 21 as when the markets were closed.
Oh, yeah. Yes.
And all those were down, right? So
you mean the brokerage account, the data
the
was
markets
down.
were
Yes,
closed,
that was,
right? You couldn't
yeah.
trade, right?
Yeah.
So that was the only day that it didn't reach that. So, you know, what is the driving all this? Like, yeah, I put something together. You know, I've used that doom loop equity nirvana thing a lot in just conversation. I actually put a post together for it, and I'll put that out. But like, I did just a quick little kind of.
Oh, thank you.
What is this? And like, this is really just super simple right here. So don't like beat me up about it. And then I'll give you something to go look at that does a deep dive into some of these like composite functions that are taking place in the actual deep math on these things. And I recommend taking a look at the PDF from Squeeze Metrics about that. But the equity nirvana piece is in effect, it grinds higher because of the options market, right? And passive indexation and ETFs. So it's a combination of the two. But effectively, when people buy calls, the dealer sells the calls, right? So he sells the calls to the buyer, and then he delta hedges the underlying. So it's a positive impact on the market. This supplies liquidity. That's a gamma definition. And then the other impact that kind of plays into this, you had thrown this over to me earlier today, was vanna, or you know, the low IV. So vanna is low implied vol or dropping implied vol, and that technically means there's abundance of liquidity or perception of abundance of liquidity. And then on top of that, that you have institutions and large players that when the liquidity is abundant, you know, or perception is abundant, they'll sell puts, which is a yield creation strategy. And then the vol short sellers target vol in this environment, right? And that is a yield creation strategy, and that's worked really well. So I don't have a name for that one. I call the put sellers the dope boys, because they're selling the dope that ends up blowing everything up. So, you know, the
sellers have made some money though the past few months, no question.
Oh yeah. Well, just keep hanging on, and it'll make sense in a second. Like everything keeps leaking higher in this environment is the presumption of liquidity, right? Is there, and the above functions only when the presumption of liquidity works, right? So then you go to the doom loop. So the flip side of that is the caveat is this has to happen very sharply. Everybody's selling puts, right? The big players selling puts. Vol is on non-existent and compressed and suppressed, right? Up in the upper section here, right? That's a whole premise of that. But that's the vanna, and then gamma is happening in all the options, right? So they're selling all the options and then buying the underlying. So it's just a natural impact. And the single stocks are all inside the indexes, so it's just a loop, right? So when the doom loop happens, it's sharply lower because of some sort of liquidity. Either it's impaired or perception of deterioration, and the negative JEX removes liquidity, right? So when there's a fire, it goes negative, but that's not really the gasoline. The gasoline's the VIX, right? And it spikes so quickly because of these, like, short sellers get crushed, they have to cover, right? Rising IV means liquidity is sucked out, right? And negative JEX removes the liquidity even further. So the institutions that sold puts end up in the money. So that it's like a disaster situation. And the only way that would really happen, because they're selling stuff so deep in the money usually for that yield play, that it has to happen fast. And so, like, it's literally like almost unreactive situation. When the liquidity deteriorates, the IVs rise to compensate, rise in IVs, right? Demand the option dealers short more of the index. So, you know, effectively, you have to ask yourself a question. And then the only time this ends is when VIX is so high that it can only go lower. Before I go any further, I want to say that, like, you can get this. I'll post this, but this Jex Ed instead of Sex Ed, but Jex Ed, right? Is from Squeeze Metrics. He's awesome, right? And this is so much. I'm really consolidating some of this, and
but you need to, because
yeah,
layman
it's really
speak. I mean,
complex.
speak
Yeah.
English. This is hard for many, and this is why I wanted to ask you to, decrypt or translate in layman's terms what all this really comes down to, the market mechanics and simple ease, just to make it
Yeah,
understandable.
Ultimately, it's the game continues and the buying can continue. When you look at the options market increase in size in the last 5 to 7 years, that the options market is wagging the dog on the underlying securities, right? And so the options market then wagging the dog becomes really only a function of these two cycles, in my opinion, right? In my opinion, that's my opinion, and that the cycles are then based on the or originated by this simple question. Really, is that is a chicken and the egg? Is it the Fed or is it the options market? So is the Fed impacting the presumed liquidity of the participants that then impacts the options market? Or is the options market becoming so large that it forces the Fed to impact liquidity? And so it's a very interesting question to ask ourselves, right? Is it the Fed, or is it the size of the options market, or is it some mechanism of both? I think that's not something I can answer, but the reality is, as long as there's a perception of liquidity and the belief that the liquidity is in abundance, right? Get the continued behaviors which drive this past the point of historical measured activity function. So like, Fibonacci's or, fans or some of these things that I see look back in time that historically would have worked, have zero relevance at this point, because there's really no way to determine how far people will bid up SPACs or everything else, IPOs, you name it. They're all related to the perception of liquidity. And if I believe that there is a greater fool going to pay me a higher price, right, and that things always go up, and I know that there's a put, so I'm an institution and I sell puts at lower levels, right? And I take on these because there's zero yields, right? So I think my 2 cents is that it's more of a function of the Fed's negative interest rate, suppressed volatility tactic environment that creates the behaviors of the expansion of the derivative environment. And so as long as the perception that the Fed will have the put or the liquidity will continue to flow, the continued activity in these options like this equity nirvana loop is just it will last longer than you think, and it will drive things further than you could imagine. But at the same time, it can vanish in a blink of an eye simply because of the way that it exists. And the whole reason that it's doing what it's doing is incinerated in a reverse situation. So as soon as, like, the key to the whole thing is like your stuff, like your volume reads, right? Your cumulative volume reads. They're and I'm not like shamelessly plugging your stuff that we're creating. It's actually extremely well crafted, in the sense that you see volume of the positioning of the underlying begin to shift. And you see the volatility structure invert, right? And that can happen ahead of these kind of displacement events. And when volatility begins to rise, implied volatility rises, that liquidity is beginning to vanish, right? Then it becomes a doom situation.
So I don't call it a doom loop in my mind. I call it sold to you market. So I use this a lot on Twitter, right, for a while, that when I see this exuberant price buying, beget buying, excessive optimism, whatever you want to call it, in spite of, and it, maybe good risk management or, fundamental weakness, whatever. I still think you're right. Perception leads reality. But what I see is under the surface, when it's a sold to you market, they actually start selling it to that, that buyer, and they're getting out. And you can kind of see that structure shift underneath. It's
Yes.
totally leading as far as I'm concerned. And it's not a
Yes.
traditional volume indicator that people are used to. But the point is, I started calling it a sold to you market over the past few years with this concept that underneath, they don't know it yet, but they're unloading on you while you're buying the highs. They're
Yeah.
going to buy. So that happened actually very strongly yesterday afternoon. You and I talked about it because we were talking
Yeah.
about the product development yesterday afternoon. Like, did just see what happened. So, but then we gapped up this morning and completely turned around, and we right back up in the channel, right? So
to an extent, right? Yeah, I
but
mean,
there's like a cliff dive that keeps they keep saving it,
well, I would say,
throwing
I would say it's, I use the poker reference all week this week, right? You paying
Yes.
poker, right? There's a bunch of different inputs. I don't like chess because it's a binary game, and as a metaphor for what we're dealing with, because that's guaranteed if then outputs. Like everybody watched the Queen's Gambit; it was really good. But like, that's all about the strategic. If this happens, that happens, and I'm, either I guessed right or I didn't guess right. It's much more like poker, right? You're waiting on all these different inputs to determine
bluff. Yes,
happen
so
with
many.
liquidity, right? So I think that, knowing that our number one variable is the liquidity, and the number two variable is the perception of liquidity, because those two not necessarily the same thing. And what we got to see what happens with the Fed, and that's the turn card I said, right? So of the cards this week, and then you got to see how the options dealers then reassess their positioning based on that, and the institutions reassess their positioning based on that. And so, I think at this point, like, you could assume that because the liquidity is in abundance, that this can continue until you see those underlying cracks. Now, you saw that crack yesterday and the day before, and I told you on Friday I really liked the read that was happening on your indicator, and it continued yesterday. Today it turned back up. It's still showing signs of like we're past the point of. I go to that Mike Green quote that I it's really good. He's at Professor.
I love him. Yep.
Yeah, he's great. Remember, there are buyers and sellers, and the dollar value of sellers is a function of the security price. So higher price equals more value I have to sell, while the value of buyers is an F. So income is collateral. So the second one doesn't grow to the sky. I think that, like, if you think about that, just a very simple statement, we're starting to get to the point where we're kind of, we've gone way past, we can continue. Yeah, for sure we can go. But what's going to continue it, right? Like, because once that does teeter over and then you get a repositioning, then
will it be a repositioning or will it just be a softening? Because I agree with you. This is liquidity driven from the March 23rd Fed intervention low, right? That was absolutely the floor of the market. And since then, 88% of major asset classes have realized a positive return so far this year. So it all better.
I think that it's really I actually posted something on a subreddit that I got invited to. Some really sharp young folks have put together. They're doing great stuff, and they were asking about these levels and so forth. I think that the 330 level in the S&P, no matter how high we go here, if we go to 3,800 or whatever, when you come back down to this 330 level, that's just going away from the options flows and then looking at the actual market structure, which will impact where those puts were sold, right? Puts were sold here, right? Specifically, that's more than likely where those are sold, without me doing some back research on it. But I suspect somewhere in here, you see things get really spicy as you got down to the 330 level and broke it. So if you got through here, right, then that would then turn it into more of a doom loop situation versus a correction. So I think anything above 330 is onward and upward, right? And anything below, And I just said this anecdotally last night, is that 290, 283, I suspect you would see some more liquidity intervention. The big deal at the end of the day is, what happened in March was it was fast, right?
Yeah.
And we're getting faster and more dramatic with these situations because we're getting
Yes.
bolder and bolder with the equity nirvana plays, right? I'm going to sell more because I can't lose. I'm going to sell more puts. I'm going to suppress vol more. Why? I can't lose, right? I mean, it's not like you can, fault people for this logic. I mean, they're being rewarded for irresponsibility. And the more reward you place for the irresponsibility, the more likelihood that the volatility on the tail is not a tail; it's a scorpion's tail. And
And the newbies, that not newbies, but you know what I mean, those who just came into the market this March, obviously, trigger for a lot of Robin Hooders, as they're called. But even Schwab reported this week they have 200% year-over-year increase in brokerage accounts. So, and that's not including their tie-up. So for me, it has birthed a whole new generation this year of very cocky traders. And I know that we talked about this in a prior show where there was like 21% of the option market are in fact these small lot Robin Hood traders.
Yep.
And that is a completely new, ingredient in the soup for market makers. So you have this large group of small traders. They're not going anywhere. They love this now. They've made, a ton of money. They're cocky as could be. Anyone can make money, kind of mindset. And then you keep having the market disavow any responsibility of policy failures or politicians that are trying to muck up the works, or major hack jobs in our security system that leaves us exposed. I keep going back to like this trade deal that never came. First for the congressional bill that they're been talking about for many moons now, it was 2-3 trillion, then it was 1.3 trillion, then it was under $1 billion, now it's like 748 billion. It's market doesn't seem to tire of the disappointment. And in the past, a normal reaction would be that's going to hurt, those who need it, and the spending and the leverage, the debt that has been accumulated that will forfeit, and the banks that are, crushing, the small, medium enterprises because of lending standards are so tight, et cetera, et cetera. But this liquidity and this vol suppression that we keep talking about over and over and over again, because it is what drives the market. It's that perception, as you mentioned. Yeah. And, away from the perception versus reality jokes, which I don't know, that's not appropriate here, but they're funny. What do you think in reality would cause this balance? Forget balance sheet, because obviously debt doesn't matter, but deficits don't matter, I should say. But what would cause this to actually flow as a risk trigger? Like, what are you looking at now? Because you say 330, but we're at what? $40 higher than that. We're at 370. So a lot of complacency is in the market. What do you see for risk factors moving forward, since obviously disappointment with Congress isn't one, FOMC is not expected to be another. So if we have the fiscal and the monetary ignored by sellers in the market, size sellers in the market, what do you see as risk factors coming down the pike?
I wrote something for, I forget what it was, like one of these periodicals last week about ETFs and passive indexation. And there's 206 ETFs that own Apple. And to me, I think what is to get this market is it'll eat itself because it's rehypothecated. So I think that's why I put that Professor Plum quote on there. It's like, at what point, because like you just listed a litany of things. It's like the fiscal stimulus is, you haven't even settled them. Nobody cares. They just expect them to do it. It's not gonna pull this away. They really can't. That I think it's the fact that there just isn't once this turns on itself, the big question would be, there will be another moment soon enough, right? Whether it's this month, next month, or the first part of next year, sometime where you're going to see that test again, where there is a selling ignited. We've taken this options market up to a whole nother level at this point. Right now, that's what's going on. And what happens at these what's the inherent reaction? It's almost like I would call it a chemical reaction, right? Is the concoction of this chemical that is the market, because I believe it's firmly a science experiment, because you've got more inputs and outputs that don't match, right? There's just too much. The derivatives are oversized as compared to the underlying securities. The ETFs hold more securities, and they and you have to dig into the ETFs. Like, they own rights to some of these things. They don't actually own the underlying. And I mean, it gets really, really weird. And so you look at that, and that's part of the thing that happened back in March. It's more so it's a risk of a chemical reaction, or a science experiment gone bad, that triggers sometime in where and taking a step further with the ETFs is like, those are indiscriminate, right? They're not discretionary, and we're moving all of our infrastructure in the wealth environment, investment technology environment, to indiscriminate algorithms, right? And so active managers, mutual funds, are just totally being like disregarded at all costs. And you would need discriminate managers to make decisions in turmoil times. And so what if we just get a period of realized volatility that's heightened for a longer period of time than the Fed could control it? What if you get inflation next year, and you get them having to raise rates to curb it? I mean, there's a few different things you could throw out there that are potential situations that occur. But I think that which trigger is less important than, once the fuse is lit, does all the nitroglycerin blow, or do they portion off part of the room? I think that's the only question that I have in my mind, is because if they portion off a part of the room, then they've been able to continue the same gambit for a period longer. If they don't, then blow the whole room up, right? Because it's just like 2008, except it's the entire options market, right?
So keep going. There's a chart I want to show you in just a second, but I actually have to tweet it.
Okay.
Because it's on my phone. It's one of those things where it's on my phone. So
yeah, so I genuinely believe, like, if you look at the underlying economy, we've eaten it, right? Buffett said yesterday, we've collateralized, we've sacrificed the small business for the sake of the whole thing. Is that really what are we seriously doing this? And he's like not considered relevant anymore. They just consider him an old guy. It doesn't matter. But he was very adamant. It's the only thing he said in the interview. He's like, we have to save the small business, or the underlying economy is gone. And so I think that I go back to, if you have pushed behavior to a lack of consequence at such a gravity a level, that yes, it can continue to into perpetuity until that moment it stops. And it's a scorpion, right? It's the tail of the volatility comes back much stronger. And we've experienced 11 years, right? This will be 2021, so 2010 on, of suppressed volatility. And they got stronger and more aggressive with it every time. I think that blew up in 2018, and they have been more aggressively addressing that in the last 2 years, and they throw more at it, and it makes it more exacerbated when this thing breaks apart. So if you look at the moves at the beginning of 2018 when XIV blew up, that was exactly what I described. That was a mini, right, or a smaller doom loop, right? It was very fast. It was very, very, very fast. Then you come to the end of 2018, it was a little bit slower, but then very fast. And then you look at 2020, and it was bigger and faster. And so each time it gets bigger and faster, right, when it breaks, because there's just so many dynamics that are just unaddressable and unknown till it takes place. So I think that the underlying economy is so fried that, and it's so bifurcated from all this, that, when and if this thing does come apart in the market, right? That's like, and I won't steal Squeeze Metric's last statement in his article. You should read it. It's interesting. what he says. And that's what I would say, it's dangerous. That's all I can say.
Okay. When does this matter? I don't know if you can see, I just shared a chart of sorts, mapping potential US home loss. Here's a look at the share of people in each state who are most at risk. 17 million Americans not current on their rent or mortgage payments. Nearly 33% face foreclosure or eviction in the next 2 months.
They can say, we're going to do a moratorium on evictions, right? But then
it expires.
Then who? Yeah, they'll extend it,
year.
right? They'll extend it. They'll go, oh, we're going to keep it going, and then the next thing is, well, who's going to deal with the paper for the property owners, right? Well, those are bonds, and then those are, individual property owners, and maybe they're commercial property owners. Like, you can't keep doing this and expect it to. It's what is your time horizon, right? Right. And we're sacrificing all this stuff because thinking that we're going to have some sort of solution on the other side. And I go back to, I think the solution is that they think that mRNA, where they've figured out how that this is going to actually solve like viruses inside. So we learn how to fix this, that we've actually, I think one of the big bets is, I've talked to a bunch of people the last 2 weeks. I'm like, tell me about this vaccine. And I am curious because I'm not a biosciences type mind. I don't really know much about that stuff. So I've been curious, and I asked, and the perception in the medical field is that this is game changing in the sense that they are found something to cure without actually infecting you with the virus, right? And that your genetic code will learn. Well, that's a big gamble, and we're going to do a kind of a live case study with all of us, right? And so, is everybody in the perception that this is going to, be something that we can solve next year, that all that debt that you're looking at right there, that it'll sort itself out. We'll back end it. We'll put it on the tail, and then we'll just, like add a couple payments to everybody's notes, right? I think that is a genuine belief, and I've heard that from several people that is what people are saying, that it's happening, right? That's going to happen, and that's the optimistic view.
I know. So we go back to that term I keep using when someone commented on a tweet today, when I actually wrote that 88% of assets are up this year. It's made for some very cocky traders, and
we got cocky scientists too right now.
And then he said, "What's your idea of And I said, excessive optimism. And we got definitely the vaccine rainbow. We still have the foreclosures. They don't recover from that very easily. So they might recover from COVID, but they are not going to recover from foreclosures as easily. And then this hit, obviously, just recently, suspected Russian hackers, but nonetheless, somebody's broke into the U.S. Department of Homeland Security and Treasury and I mean, it was just like, it's rampant. It's been going on for months. And this, of course, after Trump let go the head of cybersecurity, cyber coordinator, State Department cyber advisor. So it was basically empty and waiting to be, the house was wide open. Come in.
Yeah.
So that's a risk factor. How in your mind?
I think this goes back to the China situation that we were talking about, where it's more of a destabilization perspective than it is like and a perception of the value of your bonds. And then that goes back to the value of the bonds being, not as value, not containing the same value, or the concern of repayment, which then affects your ability to be the reserve currency. So I think that all these types of things just show that we don't have our house in order, right? And they're just more feathers in the cap of us not having our house in order, right? And I believe that if we take it even further than that, and I was thinking about this the other day, that we're throwing everything a kitchen sink at the liquidity thing because we want to continue to do what China's trying to do, which is to get foreign investment into our markets and into our economy, because that's where he who can continue to do that has that first step up in the reserve currency control, because their economy is considered the best place to be, the cleanest dirty shirt, right? And so when you look at the foreign investments into the United States, it's been pretty strong in the market the last, I don't know, 3 to 6 months. And so that's a gambit. I think that's a gambit. Isn't that a global gambit that we're trying to maintain the role of the currency by keeping our markets as a place where people get the returns in a world with no yield? And I think that is what these cyber attacks and everything else is back associated to, is, you know, discreditation of the infrastructure that we operate.
And this is way above my pay grade, so I am not speaking from a point of knowledge, but interest, keen interest. For example, you know, this was back in July of 2019. If 130 billion of fresh money is going into VC deals into 2019, that's nothing, by the way, compared to what we had in 2020. Who is funding all the billion-dollar cash-burning unicorns that aren't public? And it goes on, right? The WeWorks of the world.
Yep.
And then there's again, if you're cynical or conspiracy and you love that stuff, then you definitely want to follow. If you're just curious and a little bit worried and want to be at least in the know so you're not blindsided, I highly recommend following Deep Throat IPO, because his forensic accounting is scary detailed. And in any case, you know, he went in and basically is making a claim of this is China fueled money.
No, yeah, it's totally. Do you know the backstory? Sorry, I gotta scratch my back. The backstory about a TikTok.
Yes, I know it. Keep telling me. Yep.
Sequoia went to the White House because they have a huge investment in that alongside.
Yep.
You know, Bite the Dance, right? So they're like one of the largest shareholders in that situation, right? And so they
they're not small potatoes or without influence or without tremendous track record of success.
Yeah.
So
Completely. Yeah. So I think that is 150% spot on, right? Like that, if you dug through all that, like all of that is invested in the technology, right? And it's all, you know, foreign actors. And so it's all interconnected, right? There's no doubt.
Well, it was interesting this Sunday. Some of this, you know, metal and mining space over in China started to come down all of a sudden. Iron ore actually hit limit down. And that was the first real tremor I had seen in the XME, you know, space. I wanted to ask if you could bring up your you know, JEX charts and such of some of these ETFs to see where, because they have just flown so high, right? Small caps, XLE is a laggard, so I'm not talking about that specifically, but XRT and XME.
Sure. Yeah.
Your charts say what in regards to positioning and, you know, danger areas, because XME is very much perception of China got out of the COVID drama earlier, right? Recovery was faster. Whether or not you believe the numbers, it's the perception that demand would increase and blah, blah, blah. So we have run into the hot sun in some of these on that whole reopening reflation theme. Where are we with levels in XME in particular? Since I just saw the first tremors actually this Sunday.
Yeah, well, you could see you can see that. I mean, it starts in November with the election, right? And then
the Biden bid into the reflation trade. Yep.
Actually, right before, super interestingly enough, excuse me, it tagged the pivot. It tagged the bull bear pivot for us, which is just a formulation. And then this is the flows that kind of tested the zero bound and never really looked back. So this has been steady and bid the whole time for the last 45, 50 days. Now it's hit a level up here now that it's starting to be distributed. Like this is multiple days of distribution versus, you know, buying and selling. There's these fair value gaps that are left behind. Really, these two here are more important to the long-term structure, right? Especially this 25.85 level that would need to hold to see continuation. I think that this same theme that you see right here is the same thing that you see in XRT and
absolutely
all of them, is that there is a level that's in close proximity of roughly 20%, 25% that is you know, kind of the correction or not, right? Story, because all these were really soft. I mean, this is coming back from 2020. This is you know, met its high and you know, where it dropped out of, and then it's gone on. I think that you would give the benefit of the doubt to the reflation until it breaks. This has topped, flows topped here. It looks like on the first week after Thanksgiving, and that is confirmed by all the put buying at the ask and selling the calls at the bid. which we saw starting in the week of November 30th. So you can see that JAX is still light though. So you're going to continue to see that supportive kind of flow on that.
Okay.
People are still buying calls, but there's no progress being made at this point. This would need to continue to stay elevated rather than drop down here for us in our views. And it's really got to hold this 32 level all the way through the end of the year. Really, you're going to see next week as really important, because after options expire this week, then you'll see some repositioning through the end of the year. And I know that you had also asked me about charm, and that's time, right? That's the time effect. So that's what I was saying to the end of the year. It's not as pertinent.
Okay.
As
So
it's not measurable to.
We're gonna stick it, this landing, if you will, where we are right now before digesting higher or lower, and it times a little bit with some of the other January effects that we've had, right? So 2018 January. Same
February 2020, right? It was mid-February of 2020.
But it was January where we saw the divergence totally forming. That was 100% sold to you market. That's when I got really hot and heavy about that concept, pushing, because it was like, nope, it's forming for 1 month. We're going to have an air pocket lower because they've been selling the whole month. So it took a long time actually to unwind that.
150%. Yeah, and you can see that this has to be sorted through. This is the executed volume of underlying security for the volume profile. It's healthy. All this is fine and healthy because it was discovered way back here. This had been chopped through and bid through for a while. So it's sitting up here, right, at this levels. This has all got to be revisited to determine if this can be accepted, right? Just simple acceptance down here. So acceptance and moving forward, or rejection, which would be to come down here to 25, 29 and fail. And I think that maybe one of the bigger things is have we actually solved anything, or have we just got ourselves to the end of this road and we're like, oh shit, right? And we don't have anything to perpetuate this forward. I think that when you look at this bid and you look at this in a lot of things in the last month, it's just a liquidity bid. And so rubber meets the road next year, the first part of the year. And it can happen at any time with this test, because this is clearly distributive, right? Yeah. You're looking at right here. And this
we talked about two things that I have on the radar anyway, because I asked you your kind of risk event calendar. Mine would be, of course, the January 5th, 6th, Georgia runoff, and whether or not we get that blue wave, if you will, because election premium volatility for that election premium week just crushed, right? So they're still kind of digesting and waiting to see if there's anything to worry about into that event. And then the pension, the January effect after the Santa rally seems to be pretty volatile of late, but we also have funny business that could still percolate to the business, to the surface, including, not limited, I mean politically speaking, with that transition Trump to Biden. Sorry, I let me be very clear. And then a third would be a China Bank of China central bank would be potentially doing a rate cut, which would reverse the dollar drift lower that we've had over the past few months, which has put a tremendous tailwind behind these commodities. So those are three. I don't know the timing of an interest rate cut at the PBOC, but that's one thing. And who knows what funny business Trump has. But he's lost a lot of his helpers, let's put it that way. And this January 5th, is kind of not a big deal, because I think it's already been kind of priced in. But can you see anything else in January besides precedent? So we've had some really rocky Januaries in the past few years, big time.
I think 18 January, it was all the way through 18 January, right? So it was new inflows for the stuff, it's come to the sidelines. I got my year-end bonus check, I put it in the market, right? Whatever it be, pension rebalancing, etc. That comes in January 1. And so, you think it's going to go, it kind of just leaks in January too. I think that, I would be, but you see kind of the same pattern that we were talking about. IV, implied vol starts to rise as that stuff starts to come in. So you see green and green, green vol and green indexes start to get towards some termination. You're not seeing at all at this point, and so you could see that all the way into the middle into January. I mean, idealistically, right? If all things being equal, if nothing like triggers anything, it just is like there's a bunch of different catalysts. Like there's some catalysts that I don't even think we think of. I had mentioned on my video last night. I'm from Gainesville area, Florida, and the University of Florida basketball player that was the SEC Player of the Year. Preseason Player of the Year collapsed face first, had some sort of aneurysm or stroke or heart attack on Saturday at 11 a.m. at a basketball game, and he said, he's the most healthy people you've ever seen, and he had COVID, and
a COVID-induced stroke.
Yeah, he had it before, and he was cleared to play, and then he collapsed, and he's on a ventilator and stuff, and medically induced coma at this point. And like, how does that affect like the NCAA sports, right? That's a huge impact to the United States. That's the front and center thing. Common knowledge, as Ben Hunt would say. Everybody knows what everybody knows. It's like Harvey Weinstein thing, right?
Mm-hmm.
It's the social impacts that actually wake everybody up to what really is going on, where they're like ignoring the leases, and they're ignoring the rents, and they're ignoring all the political impacts and the
good way of putting it.
Rebalancing. It's like some wake up effect. It's like, oh my God, holy shit, this is real. And like that kid really is like, those are the types of things that because it was when the 200-day got tested back in March and broke and then came back. It was when the NBA canceled the game in the middle of the game that night, and I think it was a Oklahoma City game.
No kidding.
The next day it was limit down, and something to that effect. It's very close proximity. I don't quote me on it, but it's very close.
But correlation, causation, we're not sure, but that's interesting.
It's not that the sports drive anything or what have you. It's just that it's like, oh man, this is real. Reposition, or this has got some bond impact, right? Like with the universities, and I've talked to a lot of people. Most of these universities, without the athletic funding, or like on a shoestring, they're in deep trouble. Like, could not survive till January, February if they get another hit of any kind. These towns, et cetera. So I think that there's a lot of fragility, that anything that it becomes a common knowledge game that could impact, because I think that we're playing a common knowledge game. The common knowledge is liquidity, and so as long as that is perceived to be a godlike power, and I wrote, I'll share this kind of private blog that I've shared with some investors and stuff like that. It's like the perception that the Mayans had, that the sun was the savior, and so they gave themselves to the anything that would give the sun power, right? And they actually believed that, and so they all just did terrible things in the eyes of that perception, and didn't work out. And they had three things happen to them during the end of their civilization. It was they had a drought, so they had an economic crisis, they had a plague, and then they had a foreign power invade their shores that they were not aware of. And we believe that the dollar is the salvaging thing for us, and we worship it at all costs. And it provides us with anything we want. We just create it out of thin air. And the Fed is the temple. So this is a very interesting little allegory, but it's like, I think that plays into a big of the perception of like, I believe that the Fed is my back, right? I'll buy more options. I'll sell more puts. I would do things that I wouldn't do if I was living in the jungle. You know what I'm saying? Like, I didn't have a catch net, right? So I think that any of these things, any of these catalysts that you're mentioning, because they're all 150% accurate, it's just that right now there's a veneer that there's nothing believed, right? It's fine. We got it covered, right? And that breaks, and then you get a liquidity, right, vacuum that is the answer. So I don't know. I can honestly sit here and tell you, I don't know the answer to that. Like, and I don't even know the events at this point that it could cause. You got a young dude, he just collapses in the middle of the floor with an empty arena with paper people in the stands. And it doesn't mean anything to anybody. What does it say about us?
It reminds us life is very short.
Yeah, right. you know? So, you know, because we need to make sure that they play so that we can get the TV ads.
Mm.
Right. And sell ESPN. So, you know, if they cancel my subscription because I'm saying this, go for it.
No, I think this is just way too humanistic, Jonathan.
Yeah.
This is what, you know, humans make up trading, you know, for the most part, and we're
Right.
basing a lot of this on emotion. We're talking about perception versus reality, and equating it to this, you know, tragic death of a young basketball star. That is how it feels sometimes. That's why I'm looking at going, okay, this is I'm, you know, we're still long, but we're not as risk aware as we should be. But at the same time, we're gonna keep pressing because otherwise we're not going to get the dollars and show up for the next game. What's the alternative?
You don't
What's the alternative?
yeah, you got to keep
Win
going.
or you
Yeah.
die.
Yeah, you gotta keep playing the perception game, right? Of liquidity until you don't, right? And then be aware that when it does crack, it's gonna crack in a vacuum that's probably not manageable or quick, right? And unless you
That's
get
what happened with XIV.
and
That was way quick. I mean, you
well,
saw it happening, and right after market out, you know, closed at like 4:15. I remember watching it going, oh my God.
well, the question you have to ask yourself is, did they try? They didn't even try because they had insurance. So they didn't care. This bag holder market. That's what I love. The bag holder quotes guy. He's hilarious on Twitter, right? He's always got some.
Yeah, no, but it's real. It's real. I
They didn't
remember
care.
I remember I had a client, and he had like 2 million, and 1.5 of it was in XIV short. And there was no ability whatsoever for him to trade anything to the long side, zero to play catch up, to even break water, to break even
Yep.
with that large aside. And it had been from Brexit. So he had been stock only since Brexit, through the Trump election, and finally just came out and said, you know, I'm unbearably in pain here. When do you think this is going to reverse? And I'm like, first of all, you'll never ever be able to trade yourself out of this hole.
Mm-mm.
You could get really, really lucky and maybe break even. So that was horrible. And then I think it was like 9 months later is when XIV actually imploded. But that would have been his woohoo moment, but he couldn't take that gut wrenching. I mean, that's the human aspect of trading, right? That's just pain and suffering.
Yeah.
He would have been right. But
well, I think you can
timing.
you can take the tails, like you know, a lot of people are taking both sides, like they'll take upside and downside. So
Robert does that. He's my oil trader, right? So when he has a high conviction bet, he bets a lot. But at this point, he literally has a right tail and a left tail bet in option hedges, because we could have a geopolitical risk shoot oil higher, or we could go back to the demand destruction, right? And supply glut, just careen, we go right over the cliff. So at this point, when you kind of, and I'm sure I'm simplifying it, I don't want to minimize his logic in this, but you just brought up the left tail, the right tail. And right now, sometimes that's actually pretty profitable, because
oh yeah,
you have a spike, boom.
Yep. Yeah, and you get in these cycles, and they're actually pretty solid. I was going to do something next post. I was going to write about like that, like kind of dealing with it that way. You know, as you're.
It's the ultimate strangle. What do you call it? No, what kind of strangle? Volmageddon strangle. But what do you call it? End of whatever.
It's like an end of the world hedge, but it's
Bad.
not in the sense that you're you can bet way out on the tails pretty cheap. And they'll do
Very cheap.
Yeah, really well. And at the same time, right, you know, we're at the, if you look at IYT here on my chart, like this thing is what, up almost 95% from the lows. Like, you know, you're squeezing out, you're stepping over a steamroller to pick up 3 pennies, right? So you've got to take out some coverage on the sides, or just kind of wait for it to make a decision, right? Those are kind of your options at this point. But if you are going long, you have to have tail protection at this point. It for any period of time, right? Like I'm going long for a few days. All right, well, you know, as long as IV is not kicking like it is right now, you probably wake up tomorrow, it's going to be up a little bit more, right? Like, you know, the having said that, like anything can trigger something so fragile. So you got to have some sort of protection, right?
And we talked about it is perception. Even if debt is deflationary, we have, and you know, we had that reflation trade even kick in before the Pfizer vaccine rainbow kick in, before the Biden win kick in, and we're still just kicking up higher. But I do see this churn or this distribution right now that's very choppy in Bitcoin, you know, in the indices, as we talk about, you know, under the surface,
Yes.
where
Yes.
it's now going flat to digest, or what I call distribution. And we'll know soon enough, I think come January, if not a little bit earlier, where it's actually going to, you know, create, for me anyway, a higher probability shorting environment. But in the meantime, I had said on the when we did that the first week of December, I said, okay, we're tagging some key levels on that 4th, which was December 4th on Friday. I expect now the chop before the drop. So
Right.
I'm
Yes,
still
that's it.
convinced of that. I still believe that was the easy money was made, and now we're definitely going into chop zone. It's going to be volatile both ways, and then we'll get more of a directional feel come January. But I'm not.
This is pretty consistent with what we have seen in the last 3 times that we've seen this, where, you know, you get an initial, like, you know, outflow, right? And it's like, ooh, right? And the things start to change, and then it continues to leak higher for a little period of time, but the internals are going the opposite direction. And looking at,
or they're not following price.
correct. Yeah. And if you look at like XLE or XLF, excuse me, the bank, which are my favorite pick on, like the flows are now, you know, gone, right? Those have fallen off, right? They were immensely to the buy side, and now they're, you know, almost break even, and yet price is going to probably go higher, right? We're going to leak higher here shortly, and we're distributing. So if price does continue to go sideways or up as this continues to fade out, that's that bifurcation that you're talking about. And it's a prevalent now after this week, after Friday and Monday, that would begin to maybe create a pattern that could run for a couple of weeks. I get cautious of next week because it's short. It's a short week with December 25th, you know, Christmas.
Yes.
And the following week. But outside of that, like, I think after this week, I think it's kind of game on, right? Like, and maybe even after tomorrow with expiration of VIX, might be a little bit more game on. You might see some people actually take some action, but I don't.
I noticed actually in VIX today.
Here, I'll stop. Sure, yeah.
No, I just wanted to, I don't have to share it, but I've got to find where I actually put it, that the VIX curve went a touch backward today. Is that a spot VIX pushed itself over December VIX just a little bit. So if a deal does, you know, not happen, there's more disappointment that can enter really, really quick.
Well, you go look at the you look at the doom loop structure, right? It happens fast.
Yeah.
And that's because everybody's on the wrong side of the positioning, because they're in the greedy spot, selling, you know, vol, selling index options, and then people are buying calls. So that gets eviscerated with a rising VIX. It just gutted, and it happens that. So you're exactly right. We are starting to see it happen anytime at this point. Like,
that's what I'm looking for. And
yeah, anytime.
We'll get a chance to revisit on Tuesday next, and we'll go over. Thank you so much for the education. Seriously, this, like I said, I wanted you to speak English to us in this terminology for market structure, because it's not so easy, but it's very important to understand. So thank you for making that note sheet.
Yeah, no problem. I'll share that with you. So
please, I'll post that for sure.
Yeah, for sure. And no problem. Like there's, you know, obviously, like I said, there's people that are really studying this on next level stuff, like him, Carson, and
we still need to use it. It's got to make
totally.
You make it operationalized, you know, so that we can actually use it. So thank you very much.
Yeah, well, hat tip to those guys too. Like,
oh my God, brilliant. And I appreciate, again, this Tuesday afternoon, and I will look forward to talking with you on next Tuesday before the Christmas break, whatever. Some people take it off, or they're winding down into end of year. So volumes also tend to get much later, speaking
Later.
of liquidity,
Yep.
and that's where some really violent moves can
Yep.
happen. So
Yep. Absolutely.
we'll try and get a plan for next Tuesday. Have a great week.
All right.
my
You
God.
too.
Yeah, week.
Take care. All right.
Take care. Bye-bye.
Bye.